How do accounts receivable, undeposited funds, and the bank account all work together? How does invoicing go from creating an invoice to a payment in the checking account? These are some of the most common questions that I see with QuickBooks and one of the biggest misunderstandings. My name is AJ Stockwell. I'm a licensed CPA, and this is another video explaining some of the nuances around a particularly confusing QuickBooks feature. So I have seen a lot of confusion around accounts receivable, and this probably requires its own video talking about the different types of accounts and talking through the balance sheet, the P&L or income statement, and the statement of cash flows. Let me know in the comments if it would be helpful if I made in-depth videos explaining the different financial statements and how they interact with each other. So at the end of my QuickBooks training course, I have a quiz for people to earn a certificate of completion. And one of the questions that I see missed the most often is what type of account is accounts receivable? And many people say that it's an income account. And this is not quite right. Accounts receivable is actually an asset. It's on the balance sheet, and it's something that you own in the sense that someone owes you money. So if you have accounts receivable, you've probably already posted the income. Now, when we start with an invoice to post revenue and then we receive a payment and it goes into undeposited funds and then we want to get that money into the checking account, I understand why there's a lot of confusion because we're touching 4 different accounts just to post a sale. And in this video, I'm going to talk about each step and its effects on the financial statements. So the 4 accounts that are involved are revenue, an income account, accounts receivable, undeposited funds, and your bank account. Revenue, of course, is an income account, but the other 3 accounts are all asset accounts. So all we're really doing is moving money from one asset to another to the third. Let's start with the invoice. Our invoice is where we are recording revenue. Usually when you're invoicing a customer, it means that you are acknowledging that you've sold them something. So it posts to revenue. This indicates that someone owes you money, right? So what it's doing is posting revenue, and it's also increasing accounts receivable. Let's look at that in QuickBooks. Here's the same QuickBooks Online account that we were looking at before in the undeposited funds video. What I'm going to do is in 2 different tabs, I'm going to pull up the P&L, the profit and loss statement, and the balance sheet. So here I'll open up the P&L, and then over here, the balance sheet. This is looking at year to date, all the transactions that we've posted for this year. I'm going to set it to this month. And we see there's no activity. And then I'll do the same thing for the balance sheet, although that really just means that we're setting it to September 30th. Now what we see is that there is no activity on the P&L. There's been no income or expense recorded to September right now. We see that the checking account is at this $10,251. So I think I said that I haven't done much since the undeposited funds video, but it's actually that I haven't done much since the bank reconciliation video that I posted after that. We see that accounts receivable is $206.34 and undeposited funds is $2,300. Let's say that we sold something to a customer and we want to record that revenue and we want to invoice them because they owe us money. So I'm going to go to the new transaction window and choose invoice. I'm going to choose this John Smith customer that I've set up. We'll date it as of today because that is when the revenue is going to post. We'll say this was for web design services and we'll call it 5 hours at $116 just to make it kind of a weird number. So this invoice is for $580. Now I'm going to save and close. Again, set this to this month. And we see that we have income of $580. If I go over to the balance sheet, remember checking account, $10,200, accounts receivable, $200, and undeposited funds, $2,300. Now I'll refresh. And what we see is accounts receivable has increased by that $580. Checking account is the same as before because we haven't deposited any money to it. Undeposited funds is the same because we haven't recorded a payment yet. We haven't gotten funds that we haven't yet deposited. Now let's see what the next transaction does. It's time to receive the payment. This is great. Our customer sent us a check. I usually prefer to be paid by online payment, but let's say that our customer sent us a check. Now, we don't want to post revenue for this, right? We don't want to duplicate and post another $580 of revenue. We already recorded that. This customer no longer owes us the money, but we haven't yet deposited the check. And this is where the nuance comes in for undeposited funds. The effect of this transaction is it's going to decrease accounts receivable because the customer no longer owes us, and it's going to increase undeposited funds. Let's look at that in QuickBooks. So I'll go back to this tab, and I'm going to go to New Transaction and Receive Payment. We're going to go to our John Smith customer. We're going to say that he paid us on the 20th. We'll select this invoice, and it automatically fills in the amount received based on the invoices that we select. It's really important that we use this receive payment function because we want to close out the invoice. We want to indicate that this invoice was paid. We see that it's going to post to undeposited funds. It uses the word deposit, which I probably wouldn't use because we're saying that it's undeposited, but it's basically the account that this money is going into. I'll go ahead and save and close. And now let's look at our P&L. So I'm going to go ahead and refresh the P&L. And what we see is nothing is different. And that is what we would expect because we don't want to post another $580 of income, right? So when you receive a payment against an invoice, nothing happens to the P&L. But let's look at the balance sheet. Over on the balance sheet, and I haven't refreshed yet, remember, checking account is at $10,251. Accounts receivable shows $786 right now because that $580 invoice was in there. I haven't refreshed, so we haven't acknowledged that that invoice is closed out. And undeposited funds is at $2,300, which are the deposit amounts that we saw from those other videos. I'm going to go ahead and refresh this. Now what we see is that 580 moved from accounts receivable to undeposited funds because we received the payment. So the invoice is closed out. The customer no longer owes us, so we don't want that money to be in accounts receivable. And we've received the payment but not yet deposited it. So it's sitting here in undeposited funds within our assets. Now let's deposit that payment. Let's acknowledge that we've gone ahead and taken it to the bank or scanned it in or used the mobile app or whatever to deposit this check. The effect of this third transaction, which is recording the deposit, is to acknowledge that these funds are no longer undeposited. So we want to move it from undeposited funds to the checking account so that it reflects our correct bank balance. When we're recording a deposit of a payment, it's crucial that we actually record the payment as being deposited and don't manually set a deposit line. And I go over that in my first video about undeposited funds. Let's see this in QuickBooks. Now, remember 2880 and 10251. I'm going to go to New, Bank Deposit. We'll say we're depositing this the same day that we received it on the 20th and that it's going into this Wells Fargo account. I'll choose that John Smith payment and save and close. Now let's look at our P&L. We see nothing's changed. That's correct because we already recorded the $580 of income. Now let's look at the balance sheet. Now, undeposited funds is back down to $2,300. That's where it started at the beginning of this video. Accounts receivable is at 206.34, which is where that started for this video. But we see that our checking account is $580 higher. That's because we moved the funds from undeposited funds to the checking account. So to recap, we really are moving this same income between 3 different asset accounts. And it's really just to acknowledge that at first our customer owes us the money, then they've paid us, but we haven't yet taken it to the bank. And then we've recorded it as deposited to the bank. So now the invoice is closed out, the payment is recorded as deposited, and the checking account is the ending point of this video. What if I just ended the video right there? That really is it for the video. Thanks for watching. If this was helpful, give it a like, hit that thumbs up button, and don't forget to subscribe and hit the notification bell so that you don't miss a video. Let me know in the comments if this was helpful and if there's something about QuickBooks that you don't understand that I should make a video about.